Welcome to FX Options University. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options.
The next pattern is the double bottom or the double top. We have three rules to validate this figure. These two rules are very important because you can see double bottom or double top on every chart if you don't respect these rules. So, sorry, I think some people can't hear me.
Cyril, it's just one or two. They need to call into the conference number if they like, 866-469-3239, if they're in North America. I've been trying to send them that message. So, Cyril, just keep going.
Okay. So, the double bottom, the three rules of this double bottom. The second peak of the double bottom should be weaker than the first one, or equal. But it's important. But the balance of two peaks in time and amplitude, I mean, if the first bottom lasts 1 month, the second bottom should last 1 month or at least 1 month or around 1 month. And in amplitude means the same thing that the first rule. If you have the second peak at the same level or just weaker, you have the characteristic of a double bottom. And the neckline should have a weak slant. You can't have a double bottom with a slant like this. Okay? It's very important. The slant should be almost flat or slightly with a weak slant. Sorry. And the double top is the opposite of the double bottom, but it's a bearish pattern, while the double bottom is a bullish pattern. So you enter a long position on the double bottom when you break above the neckline. The neckline is there. Sorry, I use another color. Neckline. Sorry. Neckline is there. Okay. So you have a buy signal when you break above the neckline. In general, you have a pullback to the neckline ahead of a new up leg, but the buy signal is there. Okay. And the sell signal on the double top is when you break below the neckline, just when you break below the neckline of the double top. So you sum up, buying signal is there, the selling signal is there. Okay. That is for double bottom and double top. So the last pattern which we are focused on will be head and shoulders pattern. So the head and shoulders pattern is more complicated than the other one. You have 3 consecutive tops for the head and shoulders, 3 consecutive lows for the reverse head and shoulders. Okay, the reverse is there, the head and shoulders is there. Why head and shoulders? Sorry, because it's very simple. Because you have the first shoulder just there. Okay, shoulder 1. The head is just there. And the second shoulder is there. So the neckline, like for the double bottom and the double top, it's just under the 2 shoulders, and you have the selling signal when you break below the neckline. So there, the neckline is there. And you sell exactly when we break there. Okay? So in general, head and shoulder, the shaping of the head and shoulder take a long time, longer maybe than double bottom. So you have to wait when we are in this kind of configuration because it takes a long time. But when you have a signal with downside breakout of the neckline, it's a really, really strong selling signal. Because it took a long time, so investors are how can I say that? Investors are very aggressive on this kind of pattern, on head and shoulders especially. So the opposite is the reverse head and shoulder, the same process. You have to buy just at the upside breakout of the neckline. You have the first shoulder there, the head just there, and the second shoulder just there. So the three rules to validate this figure. You have got the two shoulders should have similar amplitude. The balance between head and two shoulders, you have to respect balance between head and two shoulders in time and amplitude, like for double bottom and double top. And the neckline should have a weak slant or a flat slant. That is for the major pattern on technical analysis. I want to focus on charting on indicators because it's very important in technical analysis and it's very important at Trading Central. So we can draw trend line on both on prices and indicators. So indicators are very useful to give indication on oversold or overbought situation, but indicators are also very useful to indicate divergence or downside breakout of trend line. So we will see how we use charting on indicators at Trading Central. So in this example, you have a rising trend line on price. So this rising trend line means that the trend is bullish. So as long as the stock or currency in this example is above this trend line, the trend is bullish. The trend will turn bearish when we have the downside breakout of the trend line. But if you see also the indicator, imagine we use RSI in this example. For example, in this example, the RSI was supported by a rising trend line too, but the RSI has broken below its rising trend line before the price. So just there, we had an indication that the momentum on price, the momentum was lower, was less bullish because the RSI broke below the trend line, but it's not the only reason to sell on price. It's very important. You have an indication. It's an indicator. The indication is momentum is bullish momentum is less important.
Please join us again next week. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts.